You check your 401k balance and see it's down 30% in 3 months. That's 12 years of contributions just gone. Except it's not actually gone. And understanding why matters more than you think. When your 401k balance drops during a crash, you're experiencing what's called a paper loss. The shares you own still exist. The companies still exist. The value dropped because other people are selling and prices fell. It only becomes a real loss if you sell when prices are down. Your account holds, let's say, 500 shares of a fund. During a crash, you still own those same 500 shares. The price per share dropped from $50 to $35. That's the key difference most people miss. During the 2008 financial crisis, the S&P 500 dropped 57% from peak to bottom. The average 401k balance fell from around $69,000 in 2007 to about $50,000 by early 2009. People who kept contributing and didn't sell recovered by 2012. Those who sold locked in permanent losses. The market itself hit new highs by 2013. During a crash, 3 things happen inside your 401k. First, the market value of your existing investments drops. That's the number you see when you log in. Second, if you're still contributing, you're now buying shares at lower prices. Same dollar amount, more shares. Third, any dividends or distributions are reinvested at those lower prices too. This is why younger workers with decades until retirement often benefit from crashes. They're accumulating shares when everything is on sale. Someone retiring next year faces a very different situation. Meet Sarah, age 28, and Tom, age 64. Both have 401ks. Both experience a 40% crash. Sarah's account drops from $45,000 to $27,000. She keeps contributing $400 monthly. Over the next 5 years, as markets recover, she ends up with more shares than if the crash never happened. Tom's account drops from $500,000 to $300,000. He's retiring in 18 months. He can't wait 5 years for recovery. Same crash, completely different impact. Age and timeline change everything. Not all 401k investments crash the same way. Stock funds typically drop the most, sometimes 30 to 50%. Bond funds usually drop less, maybe 5 to 15% depending on the type. Money market funds barely move. Target date funds automatically hold more bonds as you age, which cushions crashes when you're closer to retirement. If your 401k is 100% stocks, you'll see bigger swings both down and up. If it's 60% stocks and 40% bonds, the crash hurts less, but recoveries are slower too. In March 2020, the market dropped 34% in just 33 days. Fastest crash since 1987. But it also recovered faster than any crash in history. By August 2020, 5 months later, the S&P 500 was back to pre-crash levels. Workers who stopped contributing in March missed the entire recovery. Those who maintained or increased contributions saw their balances exceed pre-COVID levels by late 2020. Speed matters. Panic decisions during fast crashes often cause the most damage. Here's something people forget during crashes. If your employer matches 401k contributions, that match continues regardless of what the market does. You put in 6%, they add 3%. During a crash, that free money buys shares at discount prices. Some workers stop contributing when their balance drops, thinking they're protecting themselves, but they're actually losing the match and missing the chance to buy low. The employer contribution doesn't care about market conditions. It's still free money, now buying shares on sale. That compounds significantly over time. James retired January 2008 with $800,000 in his 401k. The crash hit. By March 2009, his balance was $450,000. He needed to withdraw $40,000 per year to live. But now he's selling shares at low prices to fund retirement. This is called sequence of returns risk. He had bad timing. His neighbor Linda retired January 2010 with $600,000. She experienced the recovery, not the crash. Same savings strategy, different outcome based purely on when they retired. Timing matters most at retirement. Looking at every major crash since 1950, the average recovery time to new highs is about 3.3 years. The 2000 dot-com crash took 7 years. The 1973 oil crisis crash took a year. The 1987 crash took 2 years. The Great Depression took 25 years, but that included a second crash in 1937. Most crashes in the modern era with continued contributions recover faster than the market itself because you're buying during the dip. Historical patterns don't guarantee future results, but they provide context. During a crash, you can't control when it ends or how far it drops, but you can control a few things. Your contribution rate, whether you maintain it, stop it, or even increase it. Your fund allocation, whether it matches your actual retirement timeline. Your withdrawal strategy if you're near retirement. And most importantly, whether you make emotional decisions based on daily balance checks. Many plans let you adjust how much you check your balance. Some people who check daily panic more than people who check quarterly. The account works the same either way. If you're within 5 years of retirement, some people shift toward a more conservative mix before any crash happens. This strategy reduces potential gains during good years, but cushions the fall during bad ones. It's called de-risking. Others keep a cash buffer outside the 401k to cover 1 to 2 years of expenses. That way, if they retire during a crash, they don't have to sell stocks at the bottom. They live off cash while the account recovers. These approaches have trade-offs. The key is having a plan before the crash happens, not creating one during panic. When markets crash, your 401k loses value on paper, but you still own the same number of shares. New contributions buy more shares at lower prices. Recovery time averages 3.3 years historically. Younger workers often benefit from crashes through discounted accumulation. Workers near retirement face timing risk. Your fund mix, contribution rate, and emotional response matter more than the crash itself. Employer matches continue regardless of market conditions. The worst financial damage typically comes from panic selling, not from the crash. Understanding these mechanics doesn't eliminate the stress, but it explains what's actually happening to your money. Everything covered here is for educational purposes only. This is not financial advice. Every situation is different. Consider speaking with a licensed financial advisor before making any major money decisions.